Let's go. Good morning, one and all. Welcome to the Street's opening bell here from Post 35 on the floor of the NYSE. Today is Wednesday, the 4th of January, the second trading day of the year, which, as we learned yesterday, is number 2 of 250. I'm your host, JD Durkin. That's what the blue box says. Opening bell rung moments ago by Savannah Guthrie and Hoda Kotb from the Today Show to celebrate their 5th anniversary of anchoring. They're back there along with their NBC colleagues. Congratulations to them. Stocks are trading up this morning. S&P's right now around the 38.41 level, up about 4 or 5 tenths or so after markets got off to a gloomy start on Tuesday to kick off the year. Did they ever? The major averages closed lower to kick off the first trading day of the new year as investors continue to worry about persistent inflation, a looming recession, perhaps higher interest rates. Fill in the blank with your headwind of choice here. Taking a look at what is on tap for this morning's broadcast, we will tell you what to expect this week amid a flurry of fresh economic data. Plus, Apple dropping out of the 2 trillion club after shares plummeted on Tuesday, down 3.7% in the session, now down below $2 trillion in market cap. Still ahead of Saudi Aramco for whatever it's worth, but not by a lot. We'll also discuss what lies ahead for that tech giant, as well as Tesla continuing its own downturn with shares witnessing their biggest one-day drop in over 2 years. We'll tell you what is going on. I certainly don't know, but the good news is the man who does is back in action, folks. For more on those stories and so much more on this Wednesday morning, we now welcome back our chief markets correspondent, Mr. Martin Baccardax. Martin, welcome back. I hope you had a terrific holiday stretch, a terrific new year to you, my friend. Happy and healthy to you and your loved ones. Let's dig right in, and I do want to start with what we can learn from the FOMC minutes released later today, if I'm not mistaken here. What more can we learn to give us a better sense of their deliberations to end the year, and what might it tell us for the upcoming February meeting?
I mean, I really think that the Fed's progress this year and their prospects for rate hikes are going to be the defining element for stock performance, at least in the near term. I mean, ultimately, we ended last year on that hawkish note where Jerome Powell talked about the need for higher for longer interest rates in order to keep inflation down. The cost of keeping inflation elevated was too high a price for the economy to bear. And as a result, the near-term pain was worth taking. And that was essentially the message that was delivered. The Fed itself essentially said, based on their forward projections, that they see a 5.1% interest rate in May of next year and holding that until the end of next year. So really what investors are looking for now, JD, is whether or not there was any division in those forecasts and to what degree that informed the conversation with respect to the interest rate hike that they put in place in December. You'll remember that was the 7th rate hike of the year. It was 50 basis points. It snapped that 4 rate hike streak of 75 basis points, but it was still an outsized increase from an historical perspective, and the Fed talked about more to come. So the conversation as to how we got there and where we are headed is certainly of paramount importance for the market right now. The bond market is pushing against the Fed forecasts, but nonetheless, speakers are holding to it as a result of what they see as persistently high inflation. So we'll see what that brings us, but I think you're right to sort of highlight that as the most important element, at least for the coming days, because the Fed's overhang on the market, I think, will remain critical, at least until we understand a little bit better what's happening in the fourth quarter earnings reports.
Martin, since you mentioned the bond market, I want to pick back up a topic of conversation Chris Versace and I were talking about yesterday. Mark Zandi at Moody's has made the argument with regards to an inverted yield curve to say the bond market has distortions because of the Fed's era of quantitative easing, basically buying all these treasuries, these mortgage-backed securities. Maybe his argument is maybe, just maybe, an inverted yield curve is not necessarily the recession indicator in this particular unique environment that we typically have. Since you mentioned the bond market, I want to get your take. You and I haven't talked about some of this wonky stuff in a little while. Is there something to be said there for that argument that says, hey, despite all the concerns about recession, maybe the indicators aren't necessarily pointing there because we're coming out of a very different time period than we have usually?
Yeah, I do think there's something to that thesis, JD. I think the bond market has been a reliable recession indicator for a number of decades, and for people who have spent their adult lives watching these things, yourself included, the bond market has always been the go-to place for that canary in a coal mine, for lack of a better phrase. But there's no question the price discovery is a lot more difficult now as a result of not only the quantitative easing that the Fed and central banks around the world have executed after the global financial crisis and well into the latter part of the past decade, but now also the quantitative tightening, where they are selling those bonds back into the marketplace that they scooped up over that 10-year period. The Fed's balance sheet is somewhere around the region of 7.5 to 8 trillion US dollars, mortgages, agency bonds, and billions and billions and billions of treasuries. They are all going to be dumped onto the market on a monthly basis going forward, alongside the government's regular borrowing schedule. So without question, those distortions make price discovery and what those yields mean more difficult to interpret. That said, I think the persistent inversion of the yield curve, and it has been that way since the early spring, is probably a strong signal that economic weakness is on the cards. But there is a debate as to whether or not we will tip into recession, whether it will be shallow or relatively deep, and what cost it will levy with respect to job losses and economic peril. All that said, I do think there is something to the thesis that Zandy puts forward, and I think other people in the bond market have said just as much. There is so much distortion in day-to-day price movements that it is more difficult now than it ever has been to interpret the things that we're seeing in both yields and prices and indeed day-to-day flows.
Yeah, it's great to get your perspective on something like that, because I don't want to quite call it a bit of a contrarian view, but for all the warnings of a recessionary environment, there's something in good faith to be had to explore alternative options. And I like that take, and I appreciate you being willing to address that. We've got fresh data. We love data around here, Martin. First week of the year, investors are saying, nah, okay, Santa Claus didn't maybe really come to town the way many had hoped. So we've got ISM manufacturing data. We'll get the ADP employment figures. That'll give us a bit of an indication for what Friday's jobs numbers may hold. We talked about the FOMC. We also got JOLTS survey, the job opening and labor turnover. What data points do you find to be most important? Is it one of the ones I just mentioned, or is there something that you're following that I may not legitimately even be aware of?
Well, I think one that you mentioned and one that you haven't, JD, to be honest, I think the JOLTS report, at least from my perspective, is going to be the most interesting. The ADP jobs number is relatively new, and by that I mean it only changed the way it calculated those figures back in the summertime. So the data set isn't really long enough or reliable enough for us to lean on any predictions as to what is going to mean for the Commerce Department report on Friday. That's not to say that ADP is irrelevant, but it doesn't have the same resonance as it once had. I think the JOLTS report, even though it's a month lag, is extremely important because it will again indicate the fact that there are so many people reluctant to re-enter the job market. And as a result, that likely means further wage pressures in order to entice them back. Now, of course, JD, the question is, how long does that tension remain? In other words, as people see headlines about job cuts across all different sectors, and we saw more of those today, and we'll talk about those with respect to Salesforce and a couple of other tech companies, how long can people see those headlines and remain out of the job market in the hope of a higher wage? I don't know the answer to that, but my suspicion is people will begin to get a little more unnerved about their reluctance to re-enter, and as a result will come back to maybe, if not lower, perhaps matched wages in the first part of this year. That will be good news for the Fed to some degree, because I think they'd like to see employment steady without the concurrent rise in wages. So I think the JOLTS number will provide an interesting view on that. I think the expectation is somewhere around the region of 10.3 million unfilled positions in the economy over the month of November. I do think that number is going to change quickly, however, but at least from the market's perspective, going into the Friday jobs report, that's a key number. The other that you didn't mention, JD, and I think is extremely important, are the figures that we're seeing out of Europe, both today and yesterday. Really sharp pullbacks in headline inflation figures from Germany and France, specifically Germany. That's the biggest economy in the European region, and it's the world's second largest exporter. They are seeing an enormous pullback in headline consumer prices as a result of a drop in energy costs and a milder than expected winter. If the arithmetic performs as expected in Europe, we will see those inflation numbers retreat from the record highs that we saw in the latter part of last year. And that arithmetic is very likely to be replicated here in the United States. And it's only going to give further rise to the concept of whether we've had peak inflation. Of course, US inflation has slowed for 5 consecutive months. And many people say that we're already in disinflation if we look at the month-on-month figures, even though the headline remains relatively elevated. So I think what we're seeing in Europe, if replicated here, will be extremely important. Match that against the jobs data, and you have a much better understanding of that economic cocktail going into the last part of January.
Economic cocktail. That is what I want to call this show, because
There we
every
go.
day you drop
Oh,
some
that's
gem,
perfect.
some phrase, something, you know what? In fact, hold on, folks. I'm just going to write this down so that I don't forget. And I
We need
think,
to
you know, listen,
trademark
if
this,
there's ever a
JD,
little
the
bit of a
Economic
rebrand.
Cocktail Podcast.
That's what, listen, this is what, it's a new year, time for new ideas, and I like the process of discovery, because viewers watching the show live can say, wow, I was there when Martin
Yeah.
conceived of the new idea for how we're
We're
going
blue
forward to
skying.
brand something.
This is a team effort, my man.
Yes, it is. It's wonderful. Economic cocktail. I do want to ask you about global growth worries. I know that's something on your radar. I would imagine that more or less aligns to comments made from the IMF. Perhaps I am mistaken, but give us your sense about why that's important and what is being projected here for the year ahead that you think people should keep in mind.
Yeah, the IMF had a reasonably gloomy forecast, and the expectation that as much as 2/3 of the world's economies could be in recession at some point next year. Ultimately, JD, I think the wild card in all of it is going to be how China manages its ongoing COVID crisis. They have just lurched from excessive lockdowns to a free-for-all with respect to letting the virus rip in an economy with 1.4 billion souls. There were figures out from a health NGO in the United Kingdom yesterday that estimated as many as 9,000 people could be dying each day in China if this virus goes unchecked. And that, of course, is well ahead of the government's official projections. So we really just don't know what the health cost is going to be, what the human cost is going to be, and ultimately what the economic cost is going to be for these significant and really 180-degree changes in the Chinese economy. And JD, it's worth noting that the Lunar New Year celebrations will begin early in the last part of January. People up and down the country will be going back to their homes, back to their small towns, and to celebrate with family and friends. There'll be travel all over the country, and the prospect for the virus to travel just as quickly is extreme. So I think China's prospects are going to be critical with respect to understanding how the global economy can indeed withstand these recessionary pressures. And at the moment, particularly given what we're seeing with the virus in China, it does not look good.
Since this is the first time of the new year you and I are doing this show, fans of history will know that it's not that often, Martin, that the S&P has back-to-back losing years. It happens less than 10% of the time, if I'm not mistaken there. Give us some sense on some of the broader macro headwinds that you think are important to keep in mind. Since it's been a while, you and I have had this conversation that you think could work against that trend for people that are saying, oh boy, last year was not a pretty one, but maybe this year will be better. But of course, we're not dealing with any normal economy here.
No, that's very true, JD. But what's interesting in that regard, and I think you're absolutely right, we're not dealing with a normal economy simply because we haven't really had a full understanding of how we have recovered from those post-pandemic lows, simply because that was such a black swan event without really any precedent. But what's interesting to me is that the overhang of the Fed remains as important now as it has been in times of global economic crisis. And we go back to 2009. The reason I say that is because projections for the S&P 500 this year, if you collect all the forecasts from the major banks, are at their widest levels. Widest range of forecasts that we've seen since 2009. And that mimicked the indecision that investors had with respect to what the Fed was going to do after the global financial crisis and the housing crash and all the rest of it, compared to what we expect the Fed to do now in the aftermath of the pandemic and the recovery that followed. So whilst the economic situations are quite different, it's interesting to me that they still pillar to what the Fed is likely to do, and there is still that recession or not debate. I wouldn't necessarily say it's binary, but for the most part, that is what we're looking at with respect to how these forecasts play out. But the average forecast is for a 4,000 price target for the S&P by the end of the year. That would indicate only very modest gains. from where we are right now. But again, that wide disparity between the top and the bottom forecast is the biggest it's been since 2009, and that's really indicative of the indecision I think that global investors are fighting right now.
Yeah, for people who are saying 4,000 by the end of the year, for perspective, it is, as we speak, live on air at 3,839. So that's what we're talking about with regards to the year.
It would be a year's worth of effort for very little gain and negative gain when you compare, when you strip away inflation. So that would be a lot of fighting for not a whole lot of return.
Absolutely. By the way, to your point about the efforts of, I guess, the Ben Bernanke era, going after for 08. Are you familiar with this book? This was just recommended to me. I just picked it up, started yesterday. The Lords of Easy Money. Ooh. How the Federal Reserve Broke the American Economy by Christopher Leonard. Came out in 2022. And of course, it tells the story of this era of relatively easy money, low interest rates from 08. Not just the last 2 years. We got to remember this is really a 14-year phenomenon or so. Didn't know if you were familiar with it, Martin. I'm digging in, and I will maybe have much more on it in the coming weeks.
No, I'll be interested. I mean, that zero interest rate policy was replicated by central banks all around the world. Essentially, what they did, JD, was they found themselves knocking on the floor of what they could do with regards to interest rate cuts. At some stage, you have to have a separate mechanic. In other words, once you get down to 0% in terms of interest rates, you can't go any further. So what are you going to do? You have to focus then, instead of the price of money, which is what an interest rate cut is, to the quantity of money, which is how much is out in the system. And that's where quantitative easing came from. Once the Fed realized that it got to 0% on its benchmark interest rate, the only way that it could alter market rates was to continue to buy treasury bonds, which lifts the price and lowers the yield. The assumption being that if long-term treasury bond yields are so paltry and so unattractive, investors will have no choice but to go out into the real economy and invest in things that generate wealth, generate jobs, and generate economic growth. Because when investors are worried, they go into treasury bonds, which don't really do anything for the economy at all, and they stay there until they see that things are safe. What the Fed wanted to do was say, that safety trade is not worth anything. Get out into the real world and spend some of that money so we can grow the economy. The argument now, JD, looking back on history, and there are debates on either side, is to whether that zero interest rate policy remained in place for too long. There are many people who say that it did, and there are others who say that the damage as a result of the global financial crisis was so extreme that the central banks had no other choice. I'm not sure where I come down on that debate, but it'll be interesting to see what snippets you get from the book to base the argument, which I think he is going to put forth, and that's that the Fed stayed too long in zero interest rates, and as a result, it damaged economic prospects, perhaps for a very long time.
Yeah, at least, listen, I'm early on in the book, but it does open up with former Kansas City Fed President Thomas Haunig and how he vehemently was not on the same page in his closed-door deliberations with his then FOMC colleagues, repeatedly at least framed here as the dissident to say no in this era of QE, and not on the same page with his colleagues like Janet Yellen, then a member of the Fed, of course, Ben Bernanke, then Fed chair. It's already one of these fascinating reads. Even if I'm just a few dozen pages into it, I've had a hard time putting it down, and I know that will be the case for the next few days. And maybe there are parts of this book that we can continue to have really good conversations on, because this perspective is important, Martin, as we do these conversations. I think it's important to have a bit of a bigger picture perspective, that anything happening today is a part of a much bigger picture. And that's why I always greatly appreciate the context and perspective that you bring to our broadcast every morning. Are you game to talk Apple? I want to ask you a little bit. Let's get down to the nitty gritty of the day yesterday. Shares down 3.7% yesterday. Not the start investors would like to see to the year. Now a market cap of under $2 trillion for the first time since May of last year. What do you think are some of the main factors dragging on that stock? And as a result, of course, the NASDAQ more largely to kick off the year.
Yeah, and the S&P 500 well, for that matter. I mean, Apple is just such an important stock in any benchmark, and indeed any investor portfolio. As is often said, so goes Apple, so goes the market. So what we saw yesterday, I think, was indicative of that. Really, JD, what you're looking at in the simplest terms is whether or not you have a demand concern that goes along with the understanding of the supply chain disruptions. So I'll start with those. We go back to November, and not only the worker protests at the iPhone City plant in Zhengzhou but also the broader conditions and COVID restrictions in China that disrupted supply chains and as a result limited the shipments of the new iPhone 14s, particularly the higher end models coming into the United States. Now, that is relatively well understood and relatively well reported. The question is, if, let's say, there is 8 to 10 million iPhones which didn't make it into the US by the end of December, will those units be snapped up by consumers in the 3 months ending in March? In other words, will demand extend out of the holiday season and into the next quarter? There is some debate about that. We're seeing a pullback in consumer spending, particularly with respect to discretionary items. And of course, the iPhone upgrade cycle is in question because the new models don't really deliver a great deal of incremental benefit compared to those who hold on to their older units. So there's a lot of question about demand paired with supply. There's been some data that suggests actually that US carriers are selling more iPhones than anticipated. And in fact, the September launch of the new models was successful in terms of generating growth for AT&T and Verizon and the others. But we simply just don't know yet. And we are only getting anecdotal evidence with respect to consumer spending, and we won't understand it fully until we get more details with respect to the whole of the holiday season. So that is really the twin element with respect to Apple stock performance. Do we understand the supply chain? And I think we do. And what, if any, demand effect will it have going into the March quarter? And I think that's why you're seeing such significant moves in the stock. It may simply be just a case of it being overvalued and having performed better than the NASDAQ for most of next year, and people positioning going into the earnings later in the month. But there's no question that that movement was significant yesterday.
We are 3 weeks and 1 day away from Apple's earnings report.
Yeah.
Give me some sense on what that consensus may look like. What will that conversation look like? That's going to be one of the more closely watched figures. Also amazing to think that, I don't know, we are inching closer to earnings palooza, my friend. It's going to be a busy month suddenly in the next
no question. The bank earnings will be coming up before you know it, and then tech shortly after that. I'm going by memory, JD, so please give me some leeway, but I think we're looking at a 230 bottom line for Apple shares for the December quarter. And I think, no, I don't want to say. I think the revenue number is too light inside my head. So I don't really want to put a number out there that isn't particularly accurate. But I do remember 230 per share as being the EPS forecast. Ultimately, the iPhone revenue story will be the most important element because, of course, that is reflective of what we are seeing in the supply chain disruptions. But also, JD, I think it's going to be interesting to see what growth we are witnessing in services revenue and what we are seeing as well with regards to gains for peripherals, the Apple Watch, and other sort of smaller items in the suite of products from that company. I think that will be important too, because at some stage, the upgrade cycle is going to grind to a halt, at least at the iPhone level for Apple. And as a result, they are going to have to lean on services growth, Apple Music, Apple TV, and all the rest of it in order to generate stronger revenues on a quarter-by-quarter basis. So I think it will be very important now to focus on growth rates and services alongside what we are seeing in the iPhones. Because again, as I say, I could be wrong about this, but I do believe it. At some stage, people are going to get fatigued in paying $1,100, $1,200, $1,300 for new phones that only offer tiny incremental benefits. And when they do find that fatigue, those services revenues will be exceedingly important for Apple.
What's top of mind for you with regards to the overall tech space, which of course includes Apple, but also includes a whole lot of other names we have not yet mentioned? It's not the world of tech that the stocks got to enjoy 2 years ago. It's a different challenging environment.
Yeah, I mean, free cash flow ultimately, JD, I think is going to be the most significant because that is the only way that you can lean against a hawkish Federal Reserve. Ultimately, if you have higher interest rates, you are going to push out the growth prospects of a lot of, or the ability for growth tech companies to deliver earnings. So the companies that are more about growth and potential are going to suffer more in a high interest rate environment compared to those that have mature markets and generate free cash flow. So in that respect, the big names such as Apple, Microsoft, and Google are going to be names that will have significant outperformance compared to companies at that sort of the lower point in their growth maturity scale, if you will. Let me think of some names like Roku, for instance, companies in the medical tech space. Again, probably companies in the streaming space as well. I think you are going to see a heavier burden as a result of higher interest rates compared to those which are generating free cash flow. So in the tech space, JD, I think those are going to be the two most important dynamics: where the Fed ends up with respect to its Fed funds rate, and how quickly tech companies are growing their free cash flow.
Absolutely. Okay, so while we're talking these names, I'm pulling up the chart here for Tesla. Up, not something you could say often, but it is up 9/10 for today, for whatever it's worth. But that's after a bludgeoning the stock took yesterday.
Yeah.
EV giant falling more than 12% in the session yesterday on weak delivery figures. More pain ahead, you think, here?
Certainly feels that way. I mean, I think it's been 3 quarters in a row now that they've missed delivery figures, and people are looking at the spread between demand and their ability to produce. Ultimately, Tesla doesn't begin making a car until it gets an order. So as we see deliveries and production slow, it's only indicative of the fact that demand is probably slowing alongside of it. It's still obviously robust. We're looking at year-on-year delivery gains of about 40%. And that's extraordinary by any measure. However, of course, the company itself said that it was targeting a 50% growth rate for the foreseeable future. So they missed that by 10 percentage points. And if we are looking at discounts, if we are looking at deeper incentives, and we are looking at further disruption in China and probably a bite of consumer spending as a result of the COVID crisis, all of these are going to act as headwinds, not only to profit margins for Tesla, but the overall demand equation as well. So I do think this stock has a lot to work through, not only with respect to those conditions, but also the fact that it trades at a multiple that's just so much more expensive than its automaking peers, and indeed the S&P 500 benchmark as well. And then furthermore, JD, there's a ton of short interest in the stock out there as well, which is a significant headwind in terms of near-term performance. So there is indeed a lot to fight through, I think, for those who are Tesla bulls. And even though we have seen the worst year on record and a near 72% year-on-year decline, I don't think there's any doubt that there's going to be some more red ink in the coming weeks. And it really does put a focus on those earnings that we're going to see. I think it's on the 25th of January.
And of course, what does the Twitter component of all of this look like?
Yeah.
I'm not going to ask you to make a prediction, because you and I could put together a list of 100 possible outcomes for how the whole situation is going to play itself out, and we would probably both be wrong, because however this goes is not known to anyone. But I do wonder what's been top of mind for you now that we've had a couple weeks to digest the bonkers intersection. I mean, it's difficult enough to be the CEO of one company, says a guy who's never been CEO, but I can't imagine it's very easy to be CEO of like many companies, especially companies to this scale and importance on humanity. I mean, what's the Twitter component about this for Tesla?
Well, I think it's an important point to make, isn't it, JD? Because I think what little we understand of Elon Musk is this: he's all in, I think, regardless of what operation he seems to be focusing on at the moment. So I don't think it's unfair to say that his focus on driving growth, free cash flow, and potential profitability at Twitter is coming at the expense of a lack of focus on Tesla. I don't even think that Musk would disagree with that, given that all of the vocality, if you will, that we are experiencing from him is focused on Twitter, and so little of it is focused on Tesla. Just last week, we had data from one of the funds that is controlled by Fidelity, which had a position in Twitter when it went private as a result of Musk's purchase in October. They've halved the value of that position in just a 3-month period. So that is an excellent indicator of just how significant the economic challenges are for that company, and what a task the company faces: generate free cash flow and ultimately become profitable. And of course, Elon Musk has so much of his own personal cash committed to that purchase, he probably has no other choice but to focus attention on driving growth there in order to make that purchase come good. The headwinds there are significant. Companies are pulling back, as we know, on advertising spending. That's across the tech landscape. And there's controversy with regards to his content management and some of the comments he has made and some of the people he's bringing back onto the platform and may indeed bring back in the weeks ahead. All of that suggests to me that it's a Herculean task, even if that was the only focus for Elon Musk. But of course, that's one of 4 companies that he runs. And the other company that he's most famously associated with has given up about $800 billion in market value over the past 52 weeks. I simply don't see a scenario in which investors can sit silently and watch that happen again this year without taking some drastic action. I have no idea what that action might be, but I think we are all a little bit naive to sit here and think that the current situation can continue. That is just simply too much money lost for any reasonable investor to bear, and as a result, pressure is going to follow soon.
Well, at least he's on Twitter fanning the flames of conspiracy, so that's that's a thing that we'll get to contend with still. All right, let's move on to, you want to do rapid fire? Yeah, let's do rapid fire. Let's do this, folks. The first rapid fire of the year with Martin Baccardax. Up first, let's talk GE Healthcare. That company made a debut. Martin, a big deal?
I think so. The company is really going through this historic transition where it's going to split into 3 groups: a power and renewables group, an aerospace group, and this GE Healthcare division, which makes its trading debut today. GE is still going to own about a 20% stake of it as a result of its common stock ownership. But this is a long and tedious part of the turnaround structure put into place under CEO Larry Culp, who came in a few years ago with a company that was deteriorating by the moment. He has steadied the ship and has done an excellent job, but he still has a lot more work to do. The GE Healthcare spinoff is a big part of it and successful so far. We'll see how he does with the other 2 businesses.
All right, let's talk Salesforce as well. What's behind that company laying off 10% of its workforce, Martin?
Yeah, it was a big number this morning. It surprised me, JD. There's 56,000 people who work for Salesforce around the world. So this is no joke with regards to potential job cuts. Mark Benioff is now the standalone CEO. Brett Taylor, his co-CEO, is walking away from the company at the end of the month. So this is a chance for Benioff to put his stamp on the enterprise software group. He's going to do it with this significant restructuring plan, not only job cuts, but closing some offices and paring down costs elsewhere. He's going to take $1 billion hit to fourth quarter earnings as a result of it. But again, JD, this just echoes the paring back we are seeing in hiring in the tech sector, the job cuts that we are seeing escalating into 2023, and the expectations that it likely means for corporate spending. And that's never a good sign when you are debating whether or not you're heading into recession or not.
All right, third and final, why did UBS downgrade Microsoft?
Very similar with respect to the themes that we saw with Salesforce were reflected in the UBS downgrade from Microsoft. Essentially, they're seeing weakness in Office 365, largely because that is a division that grows as a result of companies adding people to their payrolls, putting them in chairs, and putting a suite of Office products in front of them. If companies are paring back on hiring, they're going to pare back on buying 365 products. So there is weakness in revenue in that division. And the Azure Cloud division, which is the flagship for Microsoft and the biggest driver of revenue growth, is also facing weakness as a result of that and a pullback in corporate spending as well. So UBS collectively put those together, assumed that the stock was probably fairly valued right now, but with weakness ahead, it makes it a little bit overvalued. So they downgraded it to neutral from buy and cut $50 from the price target. And you're seeing a pretty significant move in the shares as a result today.
Martin Baccardax, it is wonderful to get to do this with you again here to kick off the year, and to think we did not even get to discuss the chaos within the House Republican Conference. Not that we dip our toes into the world of politics purely all too often, but there will be implications with regards to committee assignments.
No question. Debt ceiling debates and
regulations.
All
oh my! Yeah, folks, we have to raise the debt
we're going to go back to this.
There's still work for Congress to do.
It's the ghost of Christmas past, and keeps on giving, for that matter.
What a disaster! Sometimes I miss covering Congress, and then there are times I'm like, absolutely not.
Do you think you'll get the votes today, JD?
Do I think he gets the votes today? I don't think he gets the votes today. No,
I don't
I
think
don't know
he
if they
does
do
either.
another 2 to 3 rounds. I mean, he lost a number, right? He went from 19 defectors to 20 with Byron Donalds, Congressman Donalds in Florida. So he's not trending the right direction. Now, I mean, do members get a good night's sleep and wake up and are like a little less cranky the next morning? I don't know. Trump did finally weigh in, and he said, vote for Kevin, close the deal. Does that move the needle? I don't know. Maybe. It's not Trump of a few years ago, but I would say no, but who knows? I've definitely predicted politics before, and I've been disastrously wrong, Martin. So we'll see. We could have Speaker of the House this time tomorrow morning. Martin Baccardax, thank you for helping us get smarter together. Hope you have a great day, my man. Happy New Year's once again.
You too, JD. Thanks a lot. Good to see you.
You as well. All right, brother. That is going to do it for the Market Open, folks. Stick with the Street for more on these and all of the major market stories that matter to you, and we will see you tomorrow.